This problem is going to be compared to our next problem. It has some similarities, but one distinct difference. So in this next problem, we're going to be dealing with things called bond with detachable warrant. A detachable warrant, in this case, is basically a stock option. And so the ability to buy common shares of stock at a particular price for a particular period of time, that's the warrants we're talking about here. A stock option, an option. So bonds with detachable warrants, stock warrants provide the option to purchase a specified number of common shares of stock at a specified option price per share within a stated period. Essentially, two assets are being sold in one package, a bond and detachable warrants. A portion of the selling price of the bond is allocated to the detachable stock warrant. All right, so in this example, we are selling a bond, and you get along with it these stock options come along with it, like a package deal. You buy one, you get both. In the previous example with the convertible bonds, you also have an option. The key difference between this problem and the next one is that the other ones are detachable. This one, there's no way of detaching the ability to change this thing into shares of stock from the bond itself. There's no way of separating those two things out. Either you have the bond or you don't. And you can't sell the ability to change it, because then you'd have to give them the bond too. So this is non-detachable, and this is detachable. The accounting difference is here, you'll notice that we do no accounting for the conversion option. The ability to change from a bond to equity for a period of time has value. But we are not putting anything here onto our balance sheet associated with that thing of value that we are giving up. With the detachable warrant, because it can be separated out, we do give the detachable warrant a value that goes onto our financial statements. So that's the difference. If it's detachable, we account for them separately. If it's not detachable, then we just account for the bond. We ignore the conversion option when we do our accounting. Unless, of course, it gets converted, then we do the accounting like we just did on the last page. All right, example 8, bonds with detachable warrants. Horrible Inc. issues at par $10,000, $1,000 face value, 8% debt with detachable warrants that permit the holder to purchase one share of stock for $18 per share. Immediately after issue, the bonds were selling for $99. Okay, what does the 99 mean? 99% of the face amount, which is a discount. Very good. Without the warrants. In other words, if you sold them by themselves, they would be issued at 99 cents on the dollar. But if you issued them with the warrants, what price are you getting? How much? Nope. So in other words, if you issue the bond and the warrant together, how much are you getting?
18.
No. No. Any other numbers there? Pick another number. You're getting, nope. You were getting $1,000. If you give them the bond plus the detachable warrant, you're getting $1,000. They were issued at par. The bond with the detachable warrant issued together, you get $1,000. That's how much the investor gives you. If you give them just the bond by itself without the detachable warrant, they give you 99 cents on the dollar. They give you $990. If you give them just the detachable warrant, how much do they give you? $16. Very good. $16. Okay, so the key here, the first thing to realize is the value of the bond by itself and the warrant by itself does not always equal the price that you get for both together. Because usually the reason you're lumping these two things together is you're trying to encourage people to buy these things, and they don't want to for whatever reason, and so you're giving them a little bit of a deal by selling them both together. And so you'll see that the $990 plus the 16, that is more than what you're getting when you're selling them together. And it's commonly the way this thing works. And we're going to use something called the proportional method to deal with these things. And we have, great. All right, so the proportional method basically says we want to figure out what proportion of the total value is attributable to the bond and what proportion of the total value is attributable to the detachable warrant. So we're going to figure out the proportions of the total value of each one. And so here we have our warrant, and we'll go ahead and multiply everything by $10,000. 10,000 units. So we'll say this is 16 times 10,000. The total value of the warrants we're giving up is $160,000. Because if you sell the warrants all by themselves, you get $160,000. That's how much investors would be willing to give you. If you issue the bonds all by themselves, you get 99 cents on the dollar. So 990 times 10,000, you get $9,900,000. So if you sold them separately, this is how much you get for each one. Add that up, that's 10,060. So, sorry, 10,060,000. I don't know, I've got problems with numbers tonight, and other things. All right, so this is the total value if we were to sell both of these two things separately. My head's actually feeling better, so I don't want to have any problems. 10,060,000 if we sell them separately. So we want to figure out what proportion of that value is attributable to the warrants and what proportion is attributable to the bonds. So we're going to take 160,000 and divide it by 10,060,000, and we're going to find that it's 1.59% of the total value. And then we're going to take the 990,000 million, 9,900,000, and we divide it by the 10,060,000, and we're going to find out that it is 98.41% of the total value. And then obviously a total of 100%. So now we know what proportion is attributable to the warrant and what proportion is attributable to the bond. And now what we're going to do is we're going to say, all right, now when we issue the basket of both of these together, how much cash do we actually receive? And the answer is 10,000 times 1,000, because it's at par, we get a total of $10 million. That's how much cash we get when we sell all of these as basket purchases with them attached together, but detachable. And then we multiply that by each of the percentages, 1.59%, and that gives us $159,000. And then we take the 10 million, hard time, and multiply it by the 98.41%, and that gives us 9,841,000. So we are proportionally taking the 10 million that we receive and figure out what proportion is going to go to the warrants and what proportion is going to go to the bonds, and we figured out how much of that 10 million goes to each one. Does that make sense?
The 10 million is at the maturity.
The 10 million is the amount of cash we receive today. And so in fact, let's do the journal entry. We receive cash of $10 million. And it is going to be separated into two things. Into these warrants. And so we're going to do another debit here, so skip a little space. We're going to do paid in capital warrants. I don't want to get into the accounting of stock options. We're just going to call it that for now, if you don't mind. 159,000. Incidentally, you get into stock options and accounting for stock options in the intermediate 3, so you can look forward to that. So paid in capital warrants, 159. And we're going to put this much into our bond. Okay, but do we just say bond payable this amount? Is that what we do? No, because we always put the bond payable at the face amount. So let's do that. Bond payable at be at par, these numbers are going to be the same. And then to reduce it down to this, we're going to debit a discount. That's going to be 159. All right. So something I need to point out about this problem is I try to make this problem as simple as possible. But one issue with this is these numbers happen to be the same numbers. This is only because it's being issued at par. If it was any other number, these would not be the same numbers. The bond payable is 9,841,000. So we get that, 10 million minus 159 equals this number. Stock warrant is 159, this number right here. They just happen to be the same because this equals this. That's the only reason. Okay, so the key point here is, with the detachable warrant, we account for them separately. When we have a conversion option that's not detachable, we don't account for them separately. We leave them, just call it the bond all by itself. And obviously, go back here, because it's a convertible debenture, we're going to get more cash, naturally, because it's valuable. But it's just going to go into the premium or reduce the discount, depending on the problem. But it's going to be...
Convertible bond will always sell at a premium?
No. No. Like if you did a convertible bond with a state rate of 0%, it would be a discount still, but it would be a smaller discount because of the premium. I mean, because of the conversion option. Any questions on this one?
Would we see this problem where the bonds were not issued at par in the test?
I don't recall. You could. I don't see why not. You have examples in the book when they're not issued at par. There's at least one homework question that has you not issued at par.
So is there any benefit for the purchase, for the purchase?
For the investor,
Yeah.
what do you mean benefit?
So what's the rule?
So the accounting for them would be very similar to this. So they don't get a gain when they buy it, because we assume that the value of what they're getting is equal in value of what they're giving up, and so there is no gain when they get this thing. Now it may end up that if they choose to sell it, they could have a gain, but that would be, down the road. So no immediate gain. 6 minutes. Can we do fair value option in 6 minutes? What do you think? No, you don't think so?
Can you do it? We don't even know.
Can you do it?
Is this on the quiz?
I was gonna say, is it on these?
Ooh, good question. Let me look. I don't think so. No. No. Yes, dang it, it's number 4 is a fair value. All right, let's do it real quick. All right, example 9, fair value option. Oh wait, so this is a option in the U.S. GAAP accounting standards that is very rarely used. But you can, if you choose, you can account for these liabilities at their fair value instead of at the amortized cost. Almost never, no one ever does it, but you can, so we'll at least look at an example of if a firm chose to do it, what it would look like. So the company is not required to, but has the option to value some or all of its financial assets and liabilities, including bonds and notes, at fair value. If the company chooses the option to report at fair value, then it reports changes in fair value in its net income. It's not necessary for the company to elect the option to report all of its financial instruments at the fair value. You can pick and choose which ones you want. A company must make a decision when the item originates and is not allowed to switch methods once a method is chosen. So in other words, say you take out a loan, borrow money. If you want to, you can use the amortized cost, which is everything we've learned over the last couple of weeks. Or you can say, no, I want to mark this thing to its fair value at the end of each period. Almost no one does this. But it is an option, and so we'll look at it in one brief example to see what happens. And you're going to see that there's some good reasons why firms don't do this. And in fact, why it's allowed is a little beyond me, because the effects of this are very perverse. They make no sense. And you'll see what I mean when we do this problem. So, fair value option. On July 1st, this company issued $200,000 face value, 8% bonds, priced at $180,000 to yield an effective rate of 10%. So this is the stated rate, this is the market rate. They chose the fair value option for the bond. 6 months later, on December 31st, they recorded the following interest entry. And so this is going to be the journal entry for interest. And so we're going to have interest expense, which is going to be $180,000 times the market rate of 10%. Going to be semi-annual, which they are. It's going to give us $9,000 as our interest expense. Our cash, I'm doing this really fast, I apologize, you'll look at this on your own. $200,000 multiplied by the stated rate, which is 8%. 12, which is going to give us 8,000. But all stuff so far you've done before. We're going to reduce our discount of $1,000. All right. So just like we've done before, so this, everything we just did right there, you know how to do, we've done before. The difference is what happens next. So you mark it to the market as of the end of each period. So we did this journal entry to show the payment. We amortized some of the discount. We amortized $1,000 of the discount. So what's the current carrying value of this liability? 181, right? So 180 plus the 1, so 181 is the carrying value. And then at December 31st, the fair value of the bonds is 183. So what we're going to do is we're going to mark this bond from 181 to 183, with the difference being the $2,000. So effectively what we're going to do, if we are the person that issued it, we need to increase our liability. So we're going to have a bond payable. And incidentally, you can either, well, I'll make it simple. We're going to credit the bond payable $2,000. And we're going to have an unrealized loss of $2,000. So in other words, you do the journal entries just like we've done before for all the payments. When you get to the end of the period, you compare the carrying value to the fair value, mark it from the carrying value to the fair value. That's all you do. Does that make sense?
Why is it an unrealized loss?
Because we haven't sold it yet. It still goes on the income statement, but it's unrealized.
But the value is higher, right?
Correct. It's just a holding loss. Just like with investments, if we don't sell it, then it's an unrealized loss. Still goes in the income statement in here. So real quick, I still have 1 minute, let's look at why this is a very perverse thing to do, this journal entry right here. Okay, so if the carrying value is 181, the fair value is now 183, what must have happened?
Interest on it?
Okay, so the interest rate must have changed. The stated rate didn't change. The market rate of interest must have changed. What direction must have the market rate of interest must have gone?
Cash payments were paying more.
It went down, so you have a 50-50 chance, you got it that time. The market rate of interest must have gone down for this to happen. In other words, investors holding your investment, all the other investments that they have potentially, all of their returns are going down. So yours suddenly becomes more valuable, so the value goes up. Does that make sense? Or, in other words, you look less risky than everybody else. So another way to think about this is you became less risky, therefore the value of your debt goes up. When you become less risky, you have a loss. You're less risky, therefore lose. And the exact opposite happens. If you become more risky, the value of your debt goes down and you get gains. So if you do something really dumb and you become more risky, gains. That's what happens. Makes no sense. But that's exactly the way this is accounted for. All right, we're out of time. We are done with chapter 14. When we start next time, don't forget to do your quiz. Turn that in next time. Don't forget to finish your Excel assignment. Please turn that in as soon as possible. We will start on leases. We'll spend 2 full fun days talking about leases. You're going to love them. If you have any questions between now and next week, feel free to send me an email. Otherwise, have a great week.